aware of the theme concerning the workshop. We had a great time having you all. Looking forward to many more such workshops, engaging more people and on a greater level. To conclude, I wish you all a great success. So a very warm welcome to each and every one of you. If you have any questions, suggestions, please type in the chat box. Welcome all. Mr. Vivek, now you can continue.
Yes, thank you, Pankaji, for the wonderful for the introduction and the welcome address. Mayur, could you introduce the speakers, please? Could you just have a formal introduction and then we can start off with the session?
Hello. Sure, Vivekji. I'll give a brief introduction of both the speaker. Mr. Anand, with over 17 years of experience, is a tax advisor and consultant. Anand specializes in transaction-specific tax advisory services with a specific focus on real estate and infrastructure industries. Mr. Anand is a graduate in commerce from the University of Mumbai and qualified as a chartered accountant in 2002. We welcome you, Mr. Anand, at the platform of ACAE. The second speaker, Mr. Dhruv Mehta. Dhruv has been advising clients on various tax and regulatory matters since 2015, with a focus on overseas funds seeking to invest in India, transaction in real estate space, and domestic alternative fund. Dhruv is a chartered accountant and a graduate in commerce from University of Mumbai. We welcome you, Dhruv, sir, and I request the speakers to go ahead with their deliberation.
Thank you, Mayur. Thank you, Pankaji, Vivek, Sangai-ji. It's a pleasure to be speaking to all of you. Well, to start off with, good evening and welcome. I am joined on this call with my colleague Dhruv Mehta, and we kind of intend to run this session jointly. What I will do is I'll share my screen. We have a few slides and we will use that as an anchor for this conversation. We estimate that the slides should take us around an hour and 15 minutes, give or take, to talk through. And we can have a Q&A session at the end, maybe 15-20 minutes, depending on the number of questions that come up. Are you able to view the screen?
Yes, sir.
Okay, very well. So the topic that we are covering today is structuring takeovers under the IBC code. And really, when we talk of structuring, the question comes up as to, what do we mean by structuring? And at least the way within the firm we conceptualize structuring is that there are parties who are coming together to put a deal through, assuming it's an acquisition deal. Both parties will have commercial imperatives in relation to that deal. This would inter alia include your asset perimeter, the pricing of that asset, the manner in which the pricing is supposed to be delivered, and the mode through which the pricing is supposed to be delivered by the buyer to the seller. These commercial imperatives need to be fitted within the legal environment that prevails within the country. The legal environment being defined by various sets of laws that are prevailing, your corporate law, the Companies Act, your securities law, and there could be a plethora of those securities law that could interface. These are all largely relevant in the context of listed companies, but could also interface wherever there are foreign investors that are involved. Of course, there are exchange control laws for foreign investors. There's the Competition Commission, and then our bread and butter income tax laws and GST laws that would come into play. Parties to the deal would always want that this fitment of the commercial imperatives into the legal environment is done within a fixed set of parameters. And the typical parameters that we hear from parties are things like ensuring transaction certainty. So there are as limited elements as possible which could derail the transaction solely on account of structuring. The transaction timelines are curtailed, and the cash that needs to flow from the seller is delivered with as minimal leakages as possible, from the buyer to the seller. These fitment characteristics is what we at least kind of put in our minds as the structuring elements for any kind of deal that is constructed. And that is what we have taken really as a framework for developing the content of this session. So accordingly, what we have done is we have divided the overall content into 3 parts. We start off with giving a brief overview of IBC. And given that it's largely a creditor-driven process, this overview should also lay down a large portion of what the commercial imperatives in relation to the deal would be. From there, we move on to the regulatory framework that underpins the IBC and really lays out how IBC functions in real life. And then in order to kind of give a flavor of the structuring elements, we have put together a bunch of case studies that we would like to talk through. So starting off on the background and the overview of the IBC. If you look at IBC, or what prevailed before IBC was really a set of disparate recovery laws, including the Sikh Industrial Companies Act, be it the SARFAESI, the DRTs, and so on and so forth, and which were laws that really failed to deliver any material or substantial tangible results in ensuring recovery of debts or in continuation of the company that was facing financial distress. And largely this was attributed to the nature of those laws, which ensured that the defaulting promoter remained in control of the corporate debtor. And it was really the creditors who were at the mercy of the courts to get their dues repaid. What would then happen is that over time, the promoter with his control over the company would strip assets out of the company or would engage in endless litigation, which would really frustrate the overall process. This is where IBC is designed to be a game changer, because what IBC does is it dispossesses, at the outset, it dispossesses the promoter from control of the company and hands over the control of that corporate debtor to the creditors, who are then supposed to figure out the best way to maximize the value to be realized from the sale of that corporate debtor. The very fact that the promoter stands to lose control is in itself a good enough factor to galvanize the promoter to improve his credit culture. But even if things were to go south, and they do go south from time to time, the IBC is designed to ensure that this corporate debtor, which has fallen upon bad times, can be resuscitated and handed over to a more able promoter, handed over with a right size debt, handed over without any legacy issues. And this handover happens within a defined time frame to ensure that the erosion in the value of that corporate debtor is minimized to the extent possible. The key players in the IBC process are, starting off with the corporate debtor, which is the company which is undergoing troubled times. There is the resolution professional who is really managing the corporate debtor through the insolvency process on behalf of the committee of creditors. The committee of creditors is really the decision-making body which decides the fate of the corporate debtor once an insolvency is triggered. Resolution applicant is the person who is trying to bid for and acquire the corporate debtor. And the process is administered by the National Company Law Tribunal, which functions within the laws that are designed by the IBBI, which is the core body which sets out the rules and regulations for operationalizing the insolvency and the bankruptcy code.
Moving on to the process that has been laid down in this IBC code for undertaking a resolution process. The main objective of the resolution process is to ensure that the company remains as a going concern, its business can be taken over by a new management, and the creditors get their fair share. The trigger for application is a default in payment of debts, either an operational creditor or a financial creditor. In the case of an operational creditor, along with a default of minimum ₹1 crore, a 10-day notice is required after giving a notice for payment of demand. Once an application is made to the NCLT after a default, the NCLT is required to adjudicate on the admission or rejection of the application within 14 days. If an application for insolvency is admitted, then the company becomes a corporate debtor under insolvency and the CIRP process starts. In this, the NCLT first appoints an interim resolution professional who constitutes a committee of the creditors and invites them to participate in the resolution process. The committee of creditors then, once constituted, either appoints the interim resolution professional or any other professional as the resolution professional of the company and invites bids for a resolution plan from willing resolution applicants or acquirers who are willing to take over the company and pay down their debts. Now, two situations could arise. Either a resolution plan is received or not received. In case a resolution plan is received, the committee of creditors can then decide upon whether it is favorable, and the resolution professional needs to ensure that the plan which is submitted is in accordance with the four corners of the IBC. And if both criteria are satisfied, then they can take it to the adjudicating authority, which is the National Company Law Tribunal, for approval. The court, after looking into the compliance with IBC and the interest of all creditors and fairness, may decide to accept the resolution plan. In case there is no plan received or the plan is rejected by the COC or the National Company Law Tribunal, then the NCLT may direct that the company be put into liquidation. At this stage, the NCLT appoints a liquidator. The liquidator is required by law not to give up. He can still try and see if there is a willing party who can enter into compromise arrangements for transfer of at least a part of the business, if not whole, to enter into some sorts of schemes within the contours of section 230 to 232 of the Companies Act. If not that, then he is required to see if somebody is willing to buy the company or the business of the company as a going concern. And even if that fails, then he goes on for in specie distribution or distribution of the assets of the company and close it down under liquidation. So that in brief is the process that goes into a IBC company, a company which is under the CIRP.
Right. And a few nuances to what Dhruv just said is, one is the timelines that we spoke about, the timelines which have been given under the IBC code is that the admission needs to happen within 14 days, seldom adhered to by the NCLT. We have seen admissions itself being delayed for 2 to 3 months, but that's what the law says. And thereafter, there is a 330-day process to get the resolution plan done. Now, this 330 days excludes any time on account of litigation, and there is ample amount of litigation that happens in the course of the CIRP process, largely driven by the promoter, who is trying his best to ensure that he can retain the asset that is going into insolvency. But from time to time, there are also other kinds of litigations that might come up. For example, home buyers have been litigating quite a bit. There are disgruntled bidders who have been litigating, and so on and so forth. Somewhat to be expected, given that this is a new law that people will litigate. But hopefully over the medium term or so, many of these litigations would receive their quietus as the law is laid down either by the courts or through regulatory amendments or clarifications that are issued from time to time. Another small nuance is the resolution plan which is received. It's an open-ended invitation to public to bid for the asset which is on offer. There are a few things to be borne in mind, however, or rather the most important thing to be borne in mind, however, is the fact that the amount which is offered under the resolution plan cannot be less than the liquidation value of the corporate debtor. Now, this liquidation value is something that the resolution professional has to estimate and the COC has to agree to. This is a number which is not disclosed to the bidders, but if the bids that are received entail a monetization value which is lesser than the liquidation value, then the rule is that the company needs to be put into liquidation rather than going into resolution, because the money that will be realized through the liquidation would be more than the money that is realized through the resolution plan. Moving on to the next segment in that sense, what are the key enablers for acquisitions under the IBC? The first set of enablers are under the Insolvency Code itself, starting off with Section 5, which defines what a resolution plan can contain. One of the key factors is that a resolution plan must necessarily entail acquisition of the corporate debtor as a going concern. What this has been interpreted by the NCLT and I believe also the NCLAT is that there cannot be any sale of business by the corporate debtor. Because one of the options, or the most cleanest options that buyers prefer, is that they just acquire the business, leave the company which holds the business behind, which may be liquidated subsequently. But what the NCLT and the NCLAT has basically said is that given the mandate of what a resolution plan entails, it should be interpreted that the corporate debtor has to be taken up as a whole by the resolution applicant, and this takeover needs to be as a going concern. In order to facilitate the takeover, the resolution applicant may propose that the resolution plan may involve a merger, an amalgamation, or a demerger. These are just flexibilities that have been provided, and we will talk about it in greater detail subsequently. Section 31 and 32A are designed to ensure that the key objective of IBC, which is to hand over the corporate debtor free of any legacy baggage to the acquirer, is achieved. To that extent, Section 31(1) provides that the resolution plan shall be binding on all stakeholders, and all stakeholders include your financial creditors, your operational creditors, your employees, your local authorities, and the government. Specifically from a consultant's perspective, this is the section which lays down that if there are any kind of tax dues, etc., that are pending, or tax proceedings that are pending, those proceedings can be wiped out under a resolution plan. Similarly, Section 32A says that if the corporate debtor has committed any kind of malfeasance in the past, which result in prosecutable offenses, then those prosecutable offenses will not be enforced against the corporate debtor itself. And typically when any prosecutable offense is to be enforced against a corporate debtor, usually it is enforced against the directors or the persons in control of the corporate debtor. Section 32A clarifies that these proceedings shall not be enforced against the resolution applicant, nominee, directors, or the persons in control of the corporate debtor once the CIRP has been implemented. Section 238 is the motherhood section, which essentially says that in case there are any laws which provide contrarian provisions, then those contrarian provisions will be subservient to what has been decided in the CIRP. Okay, now in and of itself, section 238 is good enough to do whatever one needs to do under a CIRP. Because it essentially says that this will prevail, whatever is done in a CIRP will prevail over anything which is contrary in any other law. However, from time to time, doubts have been raised in relation to whether a provision which appears contrarian in a different law is actually contrary to the provisions of the IBC, or is it supplemental to the provisions of the IBC? Given this debate that has been raised from time to time, other regulators have been forced to step in and either bring out changes in their respective laws or issue clarificatory circulars under their respective laws to establish the primacy and supremacy of the IBC. Some of these include, for example, the Companies Act, where the MCA has issued a circular in 2017, way back in 2017, which essentially says that in case the IBC entails a procedure, and that procedure in the ordinary course would have required a shareholder's approval, then this shareholder's approval will be deemed to have been granted if that shareholder's approval is being sought as part of a process under the CIRP. Another point to note is that 238 applies not only to substantive provisions, but also to machinery provisions. For example, as we were discussing, Section 5 of the CIRP provides that a CIRP may include a merger or a demerger as part of the resolution plan. Now, typically a merger or a demerger would entail undertaking the procedures prescribed under sections 230 to 232 of the Companies Act. But if this merger or a demerger is undertaken under a CIRP, then by virtue of section 238, what can be done is that most of the procedures or all of the procedures that have been prescribed under section 230 to 232 can simply be sidestepped, and the merger or the demerger can be accomplished as a simple step in the overall CIRP process.
Moving on to one of the other enablers, which is amendments that the government has brought about in securities law. In continuation of their theme to make the IBC more workable, even for companies that are listed on the stock exchange, the government has made various amendments to securities law which govern listed companies. One of the most important amendment has been to the takeover code, wherein the government has said that now the takeover code will not be triggered if the change in control happens on account of the CIRP process. Similarly, if there is a preferential issue of shares, normally you would have had to go to your shareholders, take a special resolution, and then do the preferential issue of shares. However, the ICDR regulations now provide for an exemption in case the preferential issue of shares happens under a CIRP process. What this means is that a resolution applicant can actually invest in shares of a listed company without compliance with the ICDR. One thing to note over here, under normal circumstances, if you were to issue shares, then the ICDR regulation would provide for a lock-in period of 3 years to the shareholder. This has been relaxed to 1 year. Similarly, in case of Securities Contract Regulation Act, one could not have shareholding below 25% for public. So minimum 25% shareholding had to be maintained for public. Now, if a company goes under IBC and runs through the CIRP process, then there is a relaxation that has been granted to them. After a CIRP process, the public shareholding can fall up to 5%. It has to be brought back to 10% within 1 year and back to 25% within 3 years. The listing obligation and disclosure requirement regulations have also been relaxed. The key change in this regulation is that various actions which had to be done by the board of directors, they acknowledge that once a company goes into CIRP, the board of directors really do not have any role to play, and therefore they allow the RP to undertake most of these actions. Requirement of shareholder approval for various transactions has also been done away with. Disclosure requirements have also been relaxed. The impact of this is that if a listed company goes into the resolution process, a resolution applicant has a good, clear way path available to him to acquire the company without getting into all the so to say procedural headaches that would entail if you were to otherwise acquire a listed company. Then going on to delisting regulations. So the IBC process acknowledges the fact that once you acquire a listed company, you may either want to continue to have it as listed, or you may want to delist it and want to take it private. Ordinarily, the delisting regulations are quite cumbersome, and complying with them is really almost next to impossible. However, under the IBC, if you were to take over a listed company, you have the ability to delist the company without following the procedures that are prescribed in the delisting regulations. An exit option has to be provided to the public shareholders. The only requirement is that the price at which they are provided an exit should be same as the amount, should not be less than the amount paid to the promoter shareholders. Another option that has been provided is that in case after delisting you wish to subsequently relist the company, then that is also permissible under the delisting regulations.
From a tax perspective as well, certain amendments have been made. Most of these amendments are designed to enhance the attractiveness of the corporate debtor and make the process of IBC more robust in terms of ensuring a greater and a wider participation from interested resolution applicants. The set of these incentives or enablers from a tax perspective include Section 79. As you all might be aware, Section 79 provides that wherever there is a change of shareholding in excess of 49%, if the company is carrying any accumulated losses, those accumulated losses lapse. What the IBC provides, now the IBC fundamentally is, in an IBC, fundamentally, there is a shareholding change which is going to happen because the entire IBC is based on dispossessing the original promoter. Where Section 79 has been helpfully amended to say that if there is a change in shareholding which is triggered on account of a CIRP, the losses that the corporate debtor is carrying will not lapse. Now, there are multiple questions that arise as a consequence of this amendment. There are a few questions that we will deal with as part of our case studies. But a few technical questions which come up is when we talk about business losses or tax losses which are being carried forward by a company, what are these tax losses that are being referred to? For example, there may be a company might have filed a tax return for, let's say, assessment year 16-17, in which it had claimed a loss. And this loss has been disallowed in the course of assessment. and the company, let's say, is in appeal before the commissioner appeals on that matter. Now, what happens to that loss if this company goes into CIRP? Will the resolution applicant be entitled to carry forward the loss which was claimed under the return of income? Or would it be the revised losses that were assessed pursuant to the assessment order that was passed? A second issue could be where, let's say that returns have been filed for assessment years 19 and 20, and losses have been claimed where the assessments have not yet been completed. Now, what happens to those assessment years? Will those losses which have been filed as per the return of income be the losses that the resolution applicant is entitled to, or will it be a different number? Now, there is no clear answer to this which comes out of either the Income Tax Act or the wordings of Section 79 or out of the IBC. What we have observed, however, with judgments concerning IBC is that most of the courts, in determining which way an issue should go, whether it's a tax issue or a commercial issue or an issue under any other law, courts have gone back to saying what was the intent of IBC and what is the reading of law which would best meet that intent. Now, if we were to kind of test these two questions on the basis of that intent, the intent of IBC is that it is a robust process which hands over the corporate debtor to the resolution applicant on a clean slate basis. A clean slate would entail that the resolution applicant who is acquiring the corporate debtor knows exactly what he is paying for and what are the assets that he is inheriting, which means, and tax losses are an asset which the corporate debtor inherits, which means that the corporate debtor needs to be sure, the resolution applicant needs to be sure of what are the tax losses that the corporate debtor has to be, is entitled to. Now, tested on the basis of this, it would appear that so far as the second issue is concerned, where there is no assessment which has happened at all, it would appear that Section 79 itself provides for an opportunity being granted to the principal commissioner to present his case before the NCLT. So if the principal commissioner does present his case, then the NCLT can take that into cognizance and determine what are the amounts of losses that need to be passed on to the resolution applicant. But if the principal commissioner doesn't turn up at all, then really the resolution applicant should be good to assume that whatever are the returned losses are tax assets that he can carry forward in his books. The answer to the first question, however, is a bit tricky, where there is an assessment that has been done and the returned losses have not been accepted. The losses have been assessed at a number which is smaller than the amount of losses that were claimed as per the return of income. A conservative view, and that is probably the better course to take in these kinds of situations, it would be better to go perhaps with the amount of assessed loss as what is available to the resolution applicant, rather than taking a more aggressive stance. Moving on, the other enablers are in the form of Section 115JB, which says that if there are book losses and unabsorbed depreciation, which the corporate debtor has, then in assessing the amount of MAT that is payable by that corporate debtor, the corporate debtor would be eligible to offset the aggregate of such unabsorbed losses and depreciation as against the lower of unabsorbed losses and depreciation which is otherwise available to a regular company. Then comes Section 115BAA, which in many cases makes 115JB obsolete, because 115BAA, which is the new tax regime that has been prescribed, the concessional tax rate of 25% which has been prescribed, provides that for companies that are opting in to this 115AA are anyways not subjected to MAT. That's a significant relaxation because a CIRP by its nature entails reversal of certain liabilities. And the reversal of certain liabilities could at times, because of accounting, which recognizes these reversals as gains to be credited to the P&L account, could have triggered MAT under 115JB. Where there is a significant exposure on this count, the resolution applicant has the ability to shift the company from the normal tax regime to a 115BAA regime and get naturally exempted from the rigors of section 115JB. Benefits have also been provided under the GST law, and it's in a sense it's in fact the government which is giving stuff out of its own pocket, because under IBC what can be done is that if the corporate debtor has any kind of input tax credits, those input tax credits can be carried forward by the resolution applicant and be offset against subsequent liabilities. On the other hand, if there are any GST liabilities that are outstanding and payable, then those liabilities to the government can in fact be eliminated through the CIRP process. So in a sense, it's a giveaway by the government, and it's a measure that the government has taken to enhance, as I said, the attractiveness of the overall CIRP process.
Moving on to the impact of these various enablers that the government has provided to make the IBC process successful. So what is it that one can do under the CIRP? Given that so many enablers have been provided under the securities law, the IBC itself, and the Companies Act, what one can do under the CIRP to take control and acquire to take control of the company is that one could fund the CD by way of infusion of capital. The infusion of capital can be through whichever instrument that the acquirer desires. He can waive debts. He can also take restructuring of the company itself. He could merge one of his own companies or any company into the corporate debtor, or vice versa. He could demerge out some business or undertaking which is not critical to the going concern ability of the corporate debtor. He could do a capital reduction. He could reduce and restructure the capital of the company in a manner that he so desires once he takes over. All of these flexibilities are available for the resolution applicant to provide for in the CIRP. And once these are provided for in the CIRP and approved by the COC and the NCLT, no further process is required to be undertaken except for customary approvals and NOCs from regulators, if any. What is not permitted? Okay. While all of this is permitted, some things are not permitted. One, the CIRP process should not be used to sell the business of the company as a going concern. That is to say that you cannot sell the business of the company in a manner such that it ceases to be a going concern. In addition, you cannot sell such assets of the company if sold threaten the going concern status of the company itself. Therefore, the whole objective of the CIRP is that the company should continue as a going concern, and any action that threatens that is not permitted under the CIRP. Therefore, a slump sale of the business of the CIRP which results in the company no longer being a going concern, not permitted. Demerger of certain assets which are not critical, permitted. One more thing, all of this has to be within the four corners of what is ordinarily allowed under law. To give you an example, if a foreign investor wants to invest in a company which has FDI cap of 74%, that is to say that automatic investment in a company is restricted to 74%, and if he wants to go beyond 74%, he needs to take approval of the Reserve Bank of India. In an ordinary acquisition, the investor would first go to the Reserve Bank, take an approval, and then invest 100% if he so desires. In the case of IBC as well, this position continues. The plan can provide for an investor to acquire 100%. However, acquisition above 74% would require government approval.
So having discussed the key enablers, maybe it's a good time to just step back and take a look at, given how IBC is designed and given all the regulatory relaxations that have been provided for, how would structuring an acquisition under IBC be different from any ordinary structuring engagement that we would do? First and foremost, what we need to bear in mind is that, as against dealing with perhaps a sophisticated seller on the other side, here we are dealing with the committee of creditors who have a very focused objective, which is to maximize the value that they realize against their debt, or in other words, minimize the haircut that they need to take in respect of the debts that they have given. So as against a conventional structure where you could have some fancy modes of discharge of the consideration, you could issue equity holdings, etc. The COC is largely interested in knowing what is the amount of cash that is being put on the table and how much of that cash is being upfront being put on the table. Okay. A related point is that, notwithstanding the fact that you have to put cash upfront on the table, you don't have the benefit of a full-blown due diligence, nor do you have any seller backstop, because there are no indemnities, no warranties that are provided for. There is a clean slate which the law offers, but this clean slate is only giving you protection from any kind of misfeasance which has been done in the past. But all business related calls are something which the resolution applicant has to take on his own. For example, if a company has been in a CIRP because in the past, it really didn't have any substantive business but kept showing business by inflating its revenues, there is no way for the resolution applicant to know what were the true revenues of that corporate debt. It is really the resolution applicant who has to make an assessment of how much real revenues will he be able to generate going forward and put in a bid on the basis of his best case assessment. Again, notwithstanding the fact that a clean slate is offered by the law, unfortunately, given the way our bureaucracy works, some of these authorities will go after you. And which is what we have seen in the case of many tax proceedings being initiated after a CIRP has been done. It could either be because the tax officer is just unaware of the law, or is unaware, or is just reluctant to accept the fact that most of his tax revenues have been wiped away through the CIRP process. So given that there is this propensity to undertake mindless actions at times, it is paramount that your resolution plan that is submitted is crystal clear in terms of all the liabilities that you want wiped out. And to the extent that the resolution applicant is able to figure out what are the tax proceedings that are pending, it's a good practice to have the resolution plan spell out which of these tax proceedings are intended to be wiped out pursuant to the CIRP. And this is done only so that tomorrow, if some officer comes after you, you can just show the resolution plan and say that, look, this is a liability that we specifically asked a waiver of from the NCLT, and the NCLT has kind of approved of this waiver. Last but not the least, the resolution plan has to be simple. Not only does it help communicating what is intended to be delivered to the COC and to the other constituents, but what we also need to bear in mind is that there is a substantial time gap between the time that the resolution plan is submitted and the resolution plan is eventually approved. Theoretically, this gap could be like 3 months, but if there are any litigations, etc., which are involved, then this gap could, go up to a year, 2 years. And therefore, your resolution plan that has been submitted needs to be such that can be implemented even if there is a gap of 2 years before the implementation actually takes place. And to ensure this longevity of the resolution plan, the simpler it is, typically the longer it will survive. So those are some of the key kind of mindset changes that we need to incorporate as we think of structuring of acquisitions under the IBC. Having said that, there are some issues which still remain, notwithstanding the fact that many regulators have taken great efforts to clarify certain elements of the law, and there are also court rulings which have clarified other aspects of the law. The regulatory challenges, for example, which remain are challenges on account of the Competition Commission. A recommendation had been made to the IBBI to exempt takeovers under the IBC from the requirement of seeking a CCI approval. The IBBI has consciously not taken that request on board. So currently the way that the process works is that whilst you can make a resolution application, before the resolution application is approved, you also need to get a CCI clearance. The other issue is in relation to licenses. And this is it's a significant issue because it can compromise your entire resolution plan. Now, for example, these licenses could be, the best example is the telecom licenses. I think the going in assumption would have been that if a corporate debtor has a telecom license, then that is a telecom license which will remain with the corporate debtor. And it will pass on to the resolution applicant once the resolution application is approved. Now, the way that this works is that in respect of licenses, what the courts have observed, and at this stage, the highest court that has made this observation is the NCLAT. The appeal against the NCLAT ruling is pending before the Supreme Court, and hopefully we should hear from the Supreme Court soon. But the law as it stands today, as has been clarified by the NCLAT, is that a license, when a corporate debtor is in possession of a license, he is not an owner of the asset. He only has a right to use that asset. And if the right to use is to be transferred to the resolution applicant, then the transfer of the right to use is a prerogative of the licensor, which is the parent ministry which has granted that license. Now the parent ministry, and therefore the resolution applicant has to go and seek an approval for transfer of the license from the parent ministry. Now practically what happens is that when the resolution applicant does go to the parent ministry, the parent ministry will willy-nilly say that if you want my approval, then you clear off all my backlog dues. Now technically under the resolution process, these backlog dues form part of the operational creditors and rank below the financial creditors. But unless this specific operational creditor is cleared off, you are never going to get an approval for transfer of the license to the resolution application. And therefore, in such circumstances, essentially what it means is your resolution plan not only needs to satisfy your committee of creditors, which are your financial creditors, but now also needs to take care of at least one operational creditor, which is your licensor. And the telecom case is a much publicized case, but this is an issue which will come up where any kind of licenses are involved. For example, if there are road concessions which have been granted, in many cases there are land which has been taken on lease or license from the local municipal authority. In all of these cases, transfer of license and the payments which need to be made in order to get this transfer of license done could become a significant challenge in the overall resolution process. Exchange control guidelines, again, there are no relaxations which have been provided for, and therefore if there is a non-resident who is making a bid for a corporate debtor, all the foreign exchange regulations will apply. This would include things like what are the sectoral restrictions on the maximum stake that a non-resident can have, pricing guidelines in terms of the value at which shares can be acquired, and so on. And lastly, while a clean slate is offered in respect of all past tax dues, any transaction cost which arise as a consequence of the CIRP itself is something that is not waived off. These transaction costs could be, for example, there could be stamp duties. Stamp duties could be either on the shares, or if there are any kind of restructurings involved, then there could be stamp duty on immovable property, etc. That can also enjoin. There could be GST costs, and from time to time there could be income tax costs, especially under Section 56, etc. That need to be taken care of in terms of the CIRP process.
Various other issues also remain. What about grandfathering? Okay, suppose you have foreign taxes. Suppose a company is operating in multiple jurisdictions and has taxes due in those jurisdictions. Just because the company is undergoing CIRP in India, will it get a waiver of that tax or liability that is due in a foreign country? The question is open. More likely it may not, but depends on the willingness of the foreign country to participate in the process. Second question, what about deduction of expenses that are incurred in the CIRP process? For instance, you will have liquidator cost, you will have legal cost, or you will have cost to do valuation of various assets, determination of how to ensure that the business keeps going during the CIRP process. All of these cost money. Question is, would you get a deduction of this expenses on a going forward basis once the company is up and running again? One way to think about it is that Section 37 of the Act allows for deduction of expenses that are incurred wholly and exclusively for the purposes of the business of the company. In this case, the expenses that have been incurred are incurred so that the business of the company can go on. They are incurred solely for the purpose that the company can continue its business activities. Had they not been incurred, the company would fail as a going concern and its business would stop. In a sense, therefore, a view can be taken that these expenses should be allowable for the purposes of income tax.
And this view, Dhruv, is also supported by some old cases. These were cases in the context where there were two shareholders who had disputes amongst themselves. And one of the shareholders was threatening to pull the company into liquidation. And in order to buy peace, essentially the company undertook a capital reduction, cancelled out all the shares of one of the disputing shareholders, and paid the fair value of the shares to that shareholder. Now, in order to make this payment, the company borrowed funds, and the question before the courts was whether the interest on the borrowings that had been taken by the company in order to finance a capital reduction and a payout to the shareholder, would these be allowable expenses for the company? And where the courts have, I think there is more than one judgment on this, but what the courts have uniformly said is that had the company not undertaken that action, the company would have gone into liquidation. So in a sense, this was an action which was driven by commercial expedience. And given that commercial expedience was demonstrated, the interest on the borrowing that was taken by the company to finance this capital reduction should be regarded as an allowable expense. So I guess, reference and inference could be drawn from those cases to say that whatever costs are incurred during the CIRP also ought to be costs that qualify as tax deductible costs for the corporate debtor.
Another question that comes up is what happens to tax positions that the resolution applicant inherits in the corporate debtor. Say, for example, the corporate debtor has been leasing out premises and offering its income to tax as house property. However, the corporate resolution applicant who is taking over the corporate debtor under the CIRP is also in the same business of leasing out, and as a group policy, what he does is offer such income to tax as business income following the decision of the Supreme Court in Chennai Properties. Would the corporate resolution applicant have the ability to change the stand taken by the corporate debtor, especially if past assessments have taken place and the income tax department has accepted the position of the corporate debtor that the income earned by it from leasing out property should be offered to tax as house property? This is something that will need to be examined on a fact by fact basis. This is just one example. There could be various issues on tax positions that a corporate debtor could have inherited. For example, depreciation, manner in which depreciation is claimed, how assets are recognized. Those could be other issues that might come up.
With that, we can move into some of the structuring nuances where we have put together a bunch of case studies. There are, I believe, we have got some 6 or 7 case studies, and many would be variants and derivatives of the first case study that we would take up. But broadly, we will just cover 3 or 4 issues. We will talk about the issue, and we would talk about how that issue might be solved in the context of a CIRP. We start off with issues under Section 79. As I had mentioned, Section 79 was amended and a benefit was granted wherein losses incurred prior to the CIRP were allowed to be carried forward by the resolution applicant, notwithstanding the fact that a change in shareholding has taken place. However, the way that this amendment has been brought about creates certain doubts. And those are the doubts which we intend to cover in the next few case studies.
So let's look at a fairly straightforward case. The corporate debtor has eligible brought forward losses which pertain to AY 1920 and 2021. The two resolution applicants, investor A and investor B, propose to acquire the corporate debtor under a CIRP. The CIRP proposes for cash infusion in the corporate debtor in 2 phases. Investment by investor A for acquisition of 75% stake in March 21. Investment by investor B for acquisition of the remaining 25% stake in April 21. The CIRP concludes in April 21 on acquisition of shares by investor B. The question that is to be examined is whether carry forward and set off of losses pertaining to AY 1920 and 2021 available with the corporate debtor can be done first in 21-22 and then subsequently in 22-23.
So I think the question really revolves around the way in which Section 79 has been drafted out. 79(1) is something which is the main provision, which says that, which in essence says that in case there is a change in shareholding of more than 49%, then any losses that have been carried forward by the company will lapse and will not be allowed to be offset going forward. And then there is a Section 79 subsection 2, which provides a carve out in respect of a change in shareholding which has been occasioned on account of a CIRP. subsection 2 subclause C says that nothing contained in subsection 1 shall apply to a company where a change in shareholding takes place in a previous year pursuant to a resolution plan approved under the IBC after affording a reasonable opportunity of being heard to the jurisdictional principal commissioner or the commissioner. For a moment, let's assume that in the context of this CIRP, the principal commissioner was afforded a reasonable opportunity, and therefore that test has been met. The question then is that if you look at the way that the shareholding changes have happened, the shareholding changes have happened in 2 different years. There is investor A who comes in 21, or rather financial year 2021. And then there is a subsequent change which happens in financial year 21-22. The question is the carve out offered by subsection 2 subclause C good enough to cover both these changes in shareholding? The answer to it in our view has to be yes, because both of these shareholding changes have been pursuant to a CIRP. And when I say pursuant to, what I mean is that these shareholding changes were contemplated in the CIRP itself. And that is what the NCLT has approved. Given that this kind of shareholding changes, although they straddle multiple financial years, are shareholding changes which should get the shelter of section 79, subsection 2, subclause C.
Let's look at another scenario. Again, the corporate debtor has eligible brought forward losses. Investor A and B propose to jointly acquire the corporate debtor with a 75-25 stake. The CIRP has concluded in April 21 and the shareholding of the promoter has been cancelled. After all of this is done, in April 2022, the investor A acquires additional 5% stake in the corporate debtor from investor B. The question then is that, looking at the provisions of section 79, can the corporate debtor carry forward the losses incurred in 1920 and 2021 and set them off in AY 23-24? That is the year relevant during which the investor A has acquired additional 5% stake from investor B, which was not provided for in the CIRP.
So it's a build up on the previous example. If you look at, I'm going to annotate on the screen, but the portion which is above this line is the portion which was covered as part of the previous example. And therefore we are saying that till this time or till this step, all the losses stand protected because these shareholding changes are in accordance with what was proposed under the CIRP. Now what has happened in April 22 is that investor A has acquired an additional 5% stake. And this is something which was not contemplated under the CIRP. The question is, does this action, which is outside the resolution plan which was proposed, compromise the ability to carry forward losses? So let's look at 79 once again. 79 says that notwithstanding anything contained in this chapter, where a change in shareholding has taken place during the previous year, in the case of a company not being a company in which public are substantially interested, no loss incurred in any year prior to the previous year shall be carried forward and set off against the income of the previous year, unless on the last day of the previous year, the shares of the company carrying not less than 51% of the voting power were beneficially held by persons who were beneficially holding shares of the company carrying not less than 51% of the voting power on the last day of the year or years in which the loss was incurred. A critical point to note is that 79 is triggered whenever there is a change in shareholding. Okay, it doesn't at the outset get into what is the quantum of that change. So if there is even a single share which changes hands in the case of a private unlisted company, then section 79 is triggered. Once section 79 is triggered, then there is a second test which needs to be applied to see whether that compromises the losses. And that second test requires one to compare the shareholding in the year in which the losses were incurred with the shareholding that prevails in the year in which the losses are sought to be offset. And there has to be a 51% commonality of shareholding in both of those 2 years. Now, what has happened in the case of the corporate debtor in this case is that in April 22, there has been a change of shareholding because 5% of the shares have changed hands. So therefore, section 79 is attracted. And we are then forced to look at the second leg of the test, which is to compare whether there is commonality of shareholding between the years in which the loss was actually incurred vis-a-vis the year in which the loss is sought to be offset. And this is where things get tricky, because the year in which the loss was incurred pertains to a period which is pre-CIRP. Obviously, neither investor A nor investor B were shareholders in the CD at that time. And therefore, a strict interpretation of section 79 would seem to indicate that this kind of a change in shareholding would be something that would result in a complete lapse of all brought forward losses that the CD possesses. Now, that is what a literal reading of section 79 would indicate. The question is this reading appropriate? Generally, if you look at the context of CIRP, it would seem that this kind of a provision is not in harmony with the general emphasis of what IBC is supposed to do. You can't say that you can acquire the CIRP or the corporate debtor on the basis of certain assumptions in relation to what losses and what tax assets that corporate debtor possesses. But tomorrow, if there is a change in shareholding, and this change in shareholding could be a minuscule change in shareholding, and it could be triggered by various reasons, that is a change in shareholding which would result in all of these losses and tax assets going away from your control. Our sense is that if push comes to shove, then an argument can be made that this kind of a literal interpretation is not in keeping with the spirit of IBC. A more appropriate interpretation would require some kind of changes being made to the way that 79 is read. But perhaps that change in reading is warranted by the nature of the beast that we are dealing. The small change that we are seeking to interpose into the reading of section 79 is that the commonality of holding should be tested not vis-a-vis the year in which the loss was originally incurred, but rather to test it in the year in which the CIRP was concluded and the change in shareholding happened. So in this case, therefore, if this more harmonious interpretation is taken, all the losses of the corporate debtor should continue to remain available for offset, and they may lapse only in a case where A and B together cease to hold less than 51% of the shares of the corporate debtor.
Moving forward, slightly complicating things over here. Let us assume that A and B own company A. Company A is the successful resolution applicant and is also an industrial undertaking as defined in section 72A of the Act and has eligible brought forward losses. The resolution plan provides for merger of company A into the corporate debtor. The merger concludes, the CIRP concludes in April 21. In the following year, April 22, investor A sells 51% stake in the CD, which is the corporate debtor, to investor B. The question that now comes up for discussion: A, can company A, which had brought forward losses, take them to company CD on merger, and CD can then carry forward and set off those losses? And B, CD itself had some losses. Could those losses continue to be carried forward and set off in light of the provisions of Section 79?
The answer to this is relatively simple. I think Section 72A has an overriding clause, and essentially 72A says that whatever were the losses that the amalgamating company had become the losses of the amalgamated company. And essentially 72A results in a reset of that loss. By reset, I mean that these losses effectively get a new lease of life. So for example, some of the losses might be pertaining to assessment year 15-16, and they might have already exhausted 6 years of their utilizable life. But because these losses have now flowed as a consequence of the amalgamation, they typically get a fresh lease of life of 8 years. And the look back provisions kind of disappear. So there is no 51% look back test because the look back test cannot be applied in this case, given that the company in which the losses had been originally incurred is a company which has ceased to exist. So there is no way to kind of apply the second test under Section 79. And given that that is the case, in a circumstance where, as part of the CIRP, a merger has also taken place, the losses which the amalgamated entity is entitled to are losses that can be carried forward for the next 8 years, notwithstanding any interim change in the shareholdings that might occur in the shareholding of the amalgamated company. We will move on now to look at a few cases from a Section 56 lens.
Section 56(2)(10) of the Act was introduced in a sense to tax underpriced transactions. They are what we generally call as the gift tax provisions. What they say is that if you receive any property which includes shares and securities at a price less than the fair value of such property, then the difference between the fair value and the actual consideration paid for such property will be taxable in the hands of the acquirer. For the purposes of quoted shares, Rule 11 UA, which links to Section 56(2)(10), provides that if the transaction is undertaken on the stock exchange, then the fair market value of the shares is the Rule 11 UA value or the fair value for the purpose of Section 56(2)(10). However, if the shares are acquired outside the stock exchange of market transactions, then the lowest price of such shares quoted on the recognized stock exchange is to be considered for 56(2)(10). For unquoted shares, it is essentially the book value of the shares. The book value is computed by really reducing the assets from the liabilities. It is essentially the net worth subject to certain adjustments. Notable amongst these adjustments is in the case of immovable property, wherein the book value of the immovable property is to be ignored and the guideline value of the immovable property is to be considered. Now, why is this provision so relevant in a IBC scenario? In an IBC situation, what would normally happen is that the company would have a negative net worth, more likely because it has been unable to pay its debts. Okay, and therefore the book value of the company is negligible. What should follow ideally is that the fair value as per Section 56(2)(10) should also be negligible. However, this doesn't hold true in at least two situations. The first situation is where the company is a listed company, where even if the net worth is completely eroded and say the company has a negative net worth and therefore the price per share is zero, the traded price of the company's shares may be higher. It is interesting to note over here that once a company goes into CIRP, the SEBI does not require that the company should stop trading, or the shares of the company should stop trading. The share trading can continue to happen. In such a situation, you may have a case where the fair value, the book value of the company is zero, but for the purpose of section 56(2)(10, the fair value is higher, which is the traded price. Now, how this becomes relevant? This becomes relevant when the acquirer, who's the resolution applicant, wants to invest in shares of another of the corporate debtor. At what price should he invest? If he invests at the actual fair value, which is zero or close to zero, he may have a problem under section 56(2)(10). Similarly, in the case of real estate companies or companies that have a sizable immovable property holding, it is fairly common these days that the guideline value of immovable property is much higher than the actual fair value of the property. So in this context, let's look at a case study. This is a case study of a listed company, and let's test the gift tax provisions. The shares of the corporate debtor are listed, face value 10 rupees, traded price on the stock exchange is 200. Under the CIRP, the investor A proposes to invest rupees 10 crores in the corporate debtor. Promoter shareholding is to be cancelled completely. Public shareholding will be restructured in a manner such that they constitute 25%. Currently, promoters hold 40%, the public holds 60%. The question is that when the investor puts in rupees 10 crores in the corporate debtor by way of subscription to shares, will the gift tax provisions be attracted? If yes, how does he mitigate the exposure?
So I think this is practically what we see all the time in the context of CIRP cases where the companies are listed. And the CIRP intends to keep the company in a listed mode. We have seen this in the case of Jet Airways. We have seen this in the case of Ruchi Soya and several other cases where, although eventually the shareholders receive nothing or receive a far lesser amount, there is a significant uptick of speculative trading in the shares of these insolvent companies, which pushes up the traded price. Jet Airways, for example, is trading at some $77, although it's everything was supposed to be wiped out. So the question then is that if the investor intends to make an investment and the fair value of that investment is really zilch, should that investor be subjected to the rigors of section 56(2)(10) merely based on the price that is established by such speculative trades? If you look at the intent of section 56, then clearly it is not supposed to apply here. Okay, because this is a process that is as transparent can be. It's a process which is adjudicated upon by the National Company Law Tribunal, and it is a process that has been agreed to by a set of committee of creditors, which in many cases will involve public sector bankers. So there is no allegation from anyone whatsoever that there has been any kind of underpricing in this acquisition. But section 56, and especially the way that Rule 11 UA has been drafted, which requires fair market value to be tested on the basis of the listed price, there is a risk that someone might come after the resolution applicant if the acquisition is made at a price which is below the then trading price. Now, there are technical arguments which can be made to say that section 56 ought not to apply in this case at all. These technical arguments could be based on factors like what the intent of the law is. And increasingly, we have seen that in cases relating to Section 56, courts have been accepting arguments based on intent of the law, although the letter of the law might have been violated in certain cases. Or it could be based on the fact that, as a matter of fact, these shares are not quoted shares at all. Now, bear in mind what Rule 11 UA requires is that the shares need to be quoted. These are not listed shares, but these are quoted shares. And quoted shares are defined to mean shares which are listed and are traded regularly, and the price is established in the normal course of business. An argument could be made that once the company goes into CIRP, the quotes which are established on the stock exchange are no longer in the ordinary course of business. This can be demonstrated based on factors like the fall in the trading volumes and the fact that these are well known to be speculative trades. And hence to argue that these shares are no longer quoted shares. And because these are no longer quoted shares, the rules which are applicable to quoted shares for determination of FMV are no longer applicable, but instead what is applicable is the rules which are applicable in the context of unquoted shares, which will take you back to your book value of shares. And because most of these companies have a completely eroded book value, the acquisition at whatever price should be compliant with Section 56. Now, as a resolution applicant, is this an argument that you would want to rely upon when you are buying a new company? If I was advising the resolution applicant, we would say, while these arguments are good to have, it is always good to also comply with the letter of the law. So let's see if there is a way in which we can comply with the letter of the law. There are two scenarios that we deal with. One is a scenario in which we intend keeping the corporate debtor listed going forward after the CIRP. And a second scenario where we intend taking the corporate debtor private after the CIRP. In a case where we intend keeping the corporate debtor as a listed entity, what could be contemplated is as follows. As we said, the prevailing market price is, let's say, 200. And let's hypothesize for the moment that this is the price which prevails on the day that the CIRP is actually implemented. The way that we could implement the CIRP is that in step 1, we would cancel out all the promoter holdings because the promoter is anyway supposed to get out of the company. So this would be a capital reduction part of the CIRP, and we would cancel out all the promoter holdings without payment of any consideration. So the promoter shares have now gone out. In step 2, the investor would subscribe to his shares in the corporate debtor at the prevailing market value of $200 per share. Given that the investor is putting in 10 crores at $200 per share, he gets 500,000 shares. So his stake, he gets 500,000 shares, and in step 2, his stake goes up to 41%. In step 3, what is done is that the shares which are held by the public shareholders are cancelled or are reduced to a number which makes them on a post CIRP basis only 25% shareholders in the corporate debtor. Now, all of these steps are done as part of the CIRP and are implemented over 1 or 2 days. In fact, they can be implemented on the same day, but so that we have clearly established all the pricing benchmarks appropriately, what we would do is step 1 we would do on day 1. Step 2 is also something that we would do on day 1. And step 3 is something that we would do on day 2 after the financials for day 1 have been drawn up. In this way, what we have ensured is that the shares which have been subscribed by investor A have been at the FMV which is applicable in respect of quoted shares. And therefore, there is no allegation of Section 56(2)(10) applying in the context of the shares that investor A has acquired. In the second scenario, where we intend to delist and take private the corporate debtor, what we would do is, in step 1 of the resolution plan, we would simply delist the shares of the corporate debtor. Once these shares have been delisted, the pricing guidelines which apply in respect of quoted shares fall away, and we revert back to the pricing guidelines which are prescribed in respect of unquoted shares, which is the book value of the shares, and which in the case of the corporate debtor is unlikely to be a positive number. That is the point in time at which the investor A subscribes to shares. It could be either at the 11 UA value, but if the 11 UA value is less than the face value of the shares, then the subscription would be made at the face value of the shares. And thereafter, the promoter holdings are cancelled and the public holdings are restructured in a fashion that they become 25% holders of the company on a post CIRP basis.
Moving on, another question that keeps coming up is that investors who want to put in money into the corporate debtor want at least some debt or acquisition finance to make the resolution plan successful. Now, one would imagine that a corporate debtor is someone who's already overburdened with debt, and there would be no willing bank lender at least who would want to give money to the corporate debtor or to an applicant who's using this money to acquire a corporate debtor. However, the investor would want that at least some part of his equity or infusion in the corporate debtor is funded by way of an acquisition finance. So what are the issues? One, banks will be unwilling to lend upfront cash. Two, monies that have been borrowed by the corporate debtor may have been used for purposes that are not related to the business of the corporate debtor. So when an investor puts in the money along with a lender, a new lender, and those monies are used to repay debts, we don't know what is the end use of that debt. This brings us to the question that if you don't know the end use, you don't know whether the interest on such debt is tax deductible. If the investor is taking the acquisition finance, he would typically want that the interest on the acquisition finance is also tax deductible for him. Given this, let's just look at this example. Investor A wants to put in money of 500, out of which 250 he wants as debt. And he's also desirous of taking tax break on the interest on the acquisition finance. So how would he achieve this objective?
Yeah, so just and this is very commonly experienced in the context of CIRP companies. The problem is that the erstwhile promoter might have borrowed huge sums of money, and these sums of money might actually have been taken out of the company, lent to other group companies, and monies might have been lost in those group companies, or the monies might have been siphoned off. The question is that even if the banks were willing to lend directly to the corporate debtor, if those monies are used to repay original debts which were not utilized for the purposes of the corporate debtor's business itself, would the tax break be available in respect of the interest that is paid on the new debt that is taken? Now, if this is a risk which the resolution applicant foresees, then one other way in which the structure could be designed is that instead of the debt being taken directly at the corporate debtor, perhaps the investor could set up company A and put his $250 as equity contribution into company A. Company A would take a debt from a third-party lender of $250. The third-party lender could be either an FPI, it could be a ECB, or it could be a NBFC debt. Banks will of course not lend because these monies would be used for capital market purposes. So the banks may be unwilling to lend, but you could rely on some of these non-bank lenders for the sources of financing. And the company A then, having received the $500 of cash, would put these monies for completing the acquisition of the corporate debtor. Once the acquisition has been completed, then as part of the CIRP itself, what could be provided for is that the corporate debtor merges into company A. and it's really company A which becomes then the company that carries forward the business of the corporate debtor. Now, in this case, what has happened is that company A has certainly borrowed monies from external sources for the purposes of its own business, its business being the business of acquiring the business that was carried on by the corporate debtor and carrying forward that business. And pursuant to the merger, this is a business that vests within company A itself. And therefore, company A has a much better case to argue that the interest that it now pays on all the debts that it has borrowed in order to complete the CIRP are tax deductible against the income that may be generated by the corporate debtor.
Moving forward, another issue, and I think this is a very pertinent issue in all corporate resolution processes, is that there is always a waiver of liabilities. Most, if not all, corporate resolution processes provide that claims that are being admitted and those which are reflected in the books of accounts, at least some part of those claims is written off. This is typically going to comprise of payments to employees, to statutory authorities, and certain other operational creditors. And given that an operational or a corporate debtor is not able to pay his financial creditors and is therefore under insolvency, it is likely that these claims may not be settled at all. They may be fully or at least partly waived off. The question that then arises is that what is the income tax implication of this waiver? The resolution plan may very well say, and most resolution plans provide for that, that these expenses are to be written off. No claim will fall on the corporate debtor post such resolution plan. What is the income tax impact? This would really depend on the nature of the debt. Okay. There could be, we just try to see what could be the various types of debt that are written off. One could be capital expenses or interest on borrowings for capital expenses, where no direct deduction as such would have been claimed by the corporate debtor. The Supreme Court in the case of Mahindra has held that if it is for capital purpose, the liability will not, waiver of the liability will not attract any income tax implications. So that position is kind of settled. Then what happens to trading liabilities? If a deduction has been claimed, reversal or waiver will result in tax under section 41(1). Statutory dues, employee dues, the same principle applies. If a deduction was claimed, then reversal of that will result in a taxable event for the corporate debtor. What happens in the case of MAT? Assuming that you are a company that has not opted for the concessional tax regime under section 115BAA, then MAT could apply, or you could have potential MAT implications on waiver of these operational creditors. One would ask, why would you not opt for the concessional tax regime? There could be various things. You are claiming deduction under section 80IA, 80IAB, 10AA, and have huge losses to set off, and therefore do not want to forego the benefit. And therefore you have not opted, and the new management also does not intend to opt for 115BAA. In that case, if you write it off, then there could be a book profit arising on account of the write-off, which could result in MAT tax liability as well. The same applies for trading and statutory liabilities as well. Now, another question that comes up is that, okay, there is some gain on write-off of these liabilities, but section 79 allows that losses can be carried forward. This is a company under IBC. Naturally, it is expected to have losses. Why would I not just set off such gains against the losses that are available in my books? So various situations could happen. Situation one is that such loss actually, while claimed by the company, may not be allowable because it has not been maybe the loss was incurred because of an activity which was not for the purposes of the business and therefore is likely to be disallowed. Situation 2, you want to optimize your taxes. If section 79 says that you can carry these forward, why would you want to set them off against some liability of the past? Situation 3, the losses or the liabilities may be so large that even after writing of the losses, you may still end up in a case where you have some taxable gains on account of the write-off. All of this becomes a real issue in large insolvencies and needs to be looked at closely.
I think, so whilst the issue is significant, it's been mitigated to a large extent because of section 115 BAA. But 115 BAA didn't exist when IBC started, and there may be, as Dhruv outlined, there may be circumstances where the resolution applicant may not want to go under 115 BAA because of certain other incentives that may be lost. So this was an issue which first came up when we were working on the Alok Industries resolution. And the fairly straightforward solution that we kind of devised there was to say that what we would do is instead of taking a credit back into the P&L, we would simply convert all of these debts. In step 1, we would convert all of these debts into equity shares. And then in step 2, as an immediate next step in the CIRP process, cancel all of these shares under a capital reduction. And the credit would go directly to the balance sheet reserves rather than being credited to the P&L account. And that's the way in which the issue was sought to be mitigated then. And in many other cases, this was subsequently implemented as well. One thing that you need to bear in mind whilst implementing this kind of a plan is, of course, you need to look at Ind AS and whether that causes any kind of complications. And from a cost perspective, in many of the states, issuance of shares could entail significant costs on account of ROC fees and stamp duties. So you need to bear in mind that, and these are voluminous amounts that we are talking about. For example, in Alok, the conversion was to the extent of 25,000 crores. And if shares of that kind of value are to be issued, you can imagine the amount of stamp duty costs that may need to be incurred. So having said that, there are other states, some of the states don't have much of a stamp duty cost. Some of the eastern states have absolutely zero cost on increasing the share capital and so on and so forth. But these are nuances that we need to kind of bear in mind when we think of restructuring the amount of liabilities that are due to be paid out under a CIRP. With that, we kind of come to the end of the material that we had put together. And I'll leave the floor open for any questions that the forum might have.
Thank you so much, sir. It was really an awesome session on the topic. I'd request audience, if you have any questions, you can raise your hand and we may allow you to directly interact with the speakers, or you may note down your question in the chat box.
There is one question which is already there, which is in respect of section 281. So typically the way we try and handle the section 281 issue, so just as a bit of a background, section 281 really says that if there are any assets which are alienated during the course of any tax proceedings, then those alienations could be voided in order to recover the tax dues that eventually become payable upon the conclusion of those proceedings. Now, in the case of CIRP, typically what happens is that because the corporate debtor is taken as a going concern, there is no alienation which the corporate debtor itself does, and therefore there is no 281 which is required so far as any asset alienation from the corporate debtor is concerned. The related point is the other alienation which is happening is really the shares of the promoter are getting cancelled, and no consideration is being paid against the cancellation of those shares. Again, one can debate whether Section 281 then materially affects a cancellation of shares, which happens under a court process and which happens without any consideration having been paid. Even if the revenue was to seek to invoke Section 281, there is really nothing that they can void, because the item which has been alienated, being the shares which the promoter held, have just gone out of existence. It is not as if I have inherited the shares, so that voiding of the transaction would enable the revenue to recoup those shares from me. And to that extent, as a general proposition, Section 281 is not as much of an issue so far as your IBC proceedings are concerned. And typically, we don't see Section 281 certificates being insisted upon, or for that matter, procured when a CIRP happens.
Hello. Hello. Huh, sir.
Yes, Sachin.
Hello. Good afternoon, sir.
Yeah.
Hello. Good afternoon, sir.
You are audible. Go ahead. Sir.
Yeah. Sir, CRP process has been done. After subsequent to CRP, we are not getting Section 281 certificate. Since there is an old pre-IBC demand is outstanding in department, so what action we should take for getting the 281 certificate?
And you're saying, sir, that this pre-IBC demand has not been exhausted by the revenue authorities pursuant to the CIRP? It still continues to appear in your 26 AS?
Yeah, it is appearing in the system also. So they are not able to issue the 281 certificate, and they are not taking a stand, since they don't have any instruction in regard to pre-IBC demand, since it is huge demand, more than 200 crores. So no one want to take any chance.
No, that's the point that I was mentioning, when we were discussing about the contents of the resolution plan. This is a practical issue. The revenue just acts mindlessly so far as these things are concerned. The law is very clear that all pre-CIRP demands go away once the CIRP is approved. Because the government and the tax dues are regarded as operational creditors, and if the operational creditors are not supposed to be paid anything, then that's it. Those tax dues need to go away. Now, unfortunately, these records are not updated by the revenue authorities, and because they don't update the revenue authority those records, because first of all, they are not. In many cases, they are just not aware of the law, but in other cases, they are just lethargic about it. I think in terms of a technical answer, the way to kind of go about it is to write to one is CBDT. I think that's the second step. I was going to talk about that outsourcing center that they have in Bangalore. You have to write to them and say that there is this thing which needs to be corrected. Their most typical response is going to be that this has to be done at the level of the local AO, and this is something that they cannot do. But it is good to get that response from them. And once you have got that response, to then approach the AO and take the matter. Unlikely again that the AO will also take a call. You will have to travel up to the CIT or the principal CIT.
We have already traveled.
You have to issue instructions to have this corrected.
And only I think, sir, this is something like appeal order effect not given, something like that, because CIRP is very clear and the law is also clear, but this is the practical issue arising due to non writing of the losses or whatever it is, liabilities, isn't it?
That's true, Bankaji. Absolutely. So
furthermore, sir, they are not issuing lower deduction certificate also. Lower deduction certificate under 197 also.
No, that's true. That's true. It's very true. And typically, therefore, in order to kind of get over these issues, many a times, if there are significant tax issues which the corporate debtor has been facing, what we have also tried to do as part of the CIRP is to actually amalgamate that corporate debtor into another company. So that when we then go before the tax authorities for some of these issues like lower TDS, 281s, etc. It is not the previous corporate debtors records that they are seeing, but it is really the new company's clean sheet that they are looking at. And at least technically, they can't take recourse under some of these stupid technical provisions to deny the relief that is sought.
Thank you, sir. Thank you, sir. Thanks.
We have another question in the chat box, sir, from Neil Saab. If you can take up that.
Is it possible to assign loan to new SPV and then opt for the merger to avoid litigation on account of haircut under 41(1) and 28(4)? Neil, would it be possible to kind of elaborate on this? I'm not quite sure I followed it, because even if you were to assign loan to...
Hello.
Yeah.
So my question is that, so in case of haircut in loan, can we offer first assigning loan to new SPV, then we merge, so that whatever haircut wala jo amount, that can be considered as a reserve in merger demerger?
But Neil, then the loan would still be assigned at its full value, right? From the corporate debtor to the new SPV. And I'm assuming the new SPV here is the acquisition vehicle which you have used for making the resolution bid.
Yes.
But if the same amount of debt is assigned...
Not at par, at discounted only. At discount value only. So if suppose 100 rupees loan assigned at 20 rupees, example, then we offer merger.
I'm not sure practically that would help, Neil, because at the end of the day, the accounting treatment of it would be that an obligation of 100 of the corporate debtor has been settled for $20 or something like that, right? Because
yes.
Assignment. To that extent, the 80 of the effective haircut which has taken place is a reversal which will still happen in the books of the corporate debtor. It would require your lender also to agree for these kinds of assignments. I'm not sure that an assignment of a loan is something that the IB or the NCLT is entitled to approve. They can approve a waiver, they can approve a haircut, but I'm not sure that they can direct a lender to say that, oh, okay, instead of recovering loan from the corporate debtor, now you go and recover loan from another SPV. I suspect that that might be outside the powers that the NCLT is vested with under the IBC framework.
Yeah, okay. So subject to IBC, can we offer this type of structure for income tax consideration?
I think what could instead be done, okay, if you have to do the same thing, Neil, is instead of assigning the loan, what could be considered is that in step 1, you securitize the loan. And by securitization, I mean that let's say that there is an HDFC loan which is pending. Okay, you tell HDFC that in consideration, you convert these loans into debentures. Okay. So in step 1, you convert these loans into debentures, and the conversion is done at the full value of $100 if that was the amount of loan. And thereafter, the SPV, which is your acquisition SPV, acquires these debentures from HDFC for 20 rupees. Okay. Yeah. HDFC is settled for 20 rupees. The liability in the books of the corporate debtor still remains with $100. And thereafter, through a process of merger, the interco relationship between the SPV and the corporate debtor is eliminated. Now that would be one way to perhaps think of it, in a way that there is no reversal of liability that happens in the books of the corporate debtor. But what we need to be mindful of when we are doing this is, when we are acquiring those debentures from HDFC in this case, that the SPV is not foisted with a risk under section 56(2)(10).
Okay. So 50, but we can easily avoid 56(2)(10) as the market value of that type of debenture or fair market value of that type of debenture must be low. So
That's true. But
yeah.
it's a risk that you run, because on day one, HDFC has taken, look at the fact pattern, right?
Yeah, okay.
On the first day, HDFC has agreed to take debentures of $100, and on day two, it has sold it for $20. And the revenue, unfortunately, has the benefit of hindsight. They will look at it as, with some prejudiced eyes 3 years down the line. And you can be questioned, notwithstanding. And of course, then once questioned, you will have to demonstrate that, look at this valuation report.
Okay.
And look at the value that I was otherwise paying to all of the other operational creditors as per my resolution plan. And this, whatever I've paid to HDFC, in fact, represents the fair value of the debt that was due to HDFC at that point in time.
So officer may invoke GAR also. So in that case,
I would say, yeah, GAR.
if
GAR
if
overhang
GAR
is,
threshold, yeah,
that
okay.
overhang is always there, but in a case which is, kind of regulated by courts, overseen by courts, overseen by so many people, and it's not as if you are buying this debt from some Tom, Dick, and Harry. It's not some interest company debt. It's being brought from a reputed institution. Those are factors which would demonstrate that there is no avoidance mechanism which is being triggered here.
Okay. Thank you, sir.
Appreciate it.
Any other question in the audience? Anupji, you are mute.
No hand raised. Huh? No question in the chat box.
No, all the question has been taken care of.
Okay. Thank you, sir, for elaborate coverage of takeover under IBC, and you have, I think, cover all the aspects which is related with takeover in IBC, and most of the question you have already taken. So now I ask Mayur to offer formal vote of thanks to the speakers. Mayur.
Thank you, Anupji. Respected Anand sir, Dhruv sir, and dear delegates, I, on behalf of ACE, extends my most sincere gratitude to both the speakers, CA Anand Lakshmeshwar and CA Dhruv Mehta. We got the opportunity to hear your thoughts on structuring takeover under IBC law. Thank you once again, sir. We, on behalf of ACE, would like to offer you an e-memento, which you can make part of your e-library. This one is for Anand sir, and this one is for Dhruv sir. We'll also be mailing you these e-mementos. Thank you so much once again, sir. And I pass my warm thanks to all the audience for their sincere presence in this meeting. For the information of the audience, tomorrow our speaker is Dr. Anup Saha, who will be speaking on settlement of shares under trust, family arrangement, gift, and succession of business. Thank you all.
Thank you, sir. Thank you. With your permission, we are closing this session.
Sure.
Just a small request to Anandji. Sir, if you can share the PPT, because many of the audience would like to have that. If you can mail us or share it with us.
Yeah, we will send it across. Thank you once again.
Thank you.